Welcome back to the program. Johnson Chukwu, who is the Group Managing Director at Cowry Asset Management, joins me right now from Lagos. Mr. Chukwu, welcome to the program.
Thank you, Nancy, for having me. Good morning.
Good morning. Now, let's get started with the latest. President Biden of the United States announced that the United States would ban Russian import, Russian oil, while the UK says that it will phase out purchases. The EU, on one hand, cannot actually do what the US or the UK plans to do. What do you think will be the immediate effect on global oil supply, then on Nigerian oil?
Okay, in the first place, remember that Russia currently supplies is the second largest exporter of crude in the world, the third largest crude producer and second largest exporter. As it stands today, Western European countries depend largely, about 35% of their energy supply sources come from Russia, gas and crude. So if with the ban that the U.S. has placed, U.S. is relatively in a strong position to place a ban on Russian oil because U.S. has almost attained self-sufficiency in crude oil need or crude oil demand. As it stands today, U.S. is actually the largest crude oil producer in the world, but also the largest crude oil consumer in the world. And U.S. has gradually ratcheted up its crude production to a level that it can afford to be self-sufficient in crude oil consumption. So, but that is not the same with European countries. And what the announcement effect of that Biden statement that they're banning the importation of Russian crude oil and also liquefied natural gas from Russia is that they're going to see a spike. Of course, we see a gyration in the prices of crude oil yesterday when the announcement was made. We saw a situation where the crude oil price touched about $130. Today it has dropped back to about $126 today after the world has weighed the implication of that. But the reality is that the Western European countries cannot afford to follow suit. And that's why Britain said they're going to phase their exit from Russian oil. They're going to phase it, and I believe the phasing will take a number of years to achieve. But countries like Germany and other European countries that are getting their gas supply directly from Russia and their crude oil supply from Russian oil wells cannot afford that ban. And remember that most refined petroleum products currently produced, they're coming to other countries like Nigeria, are refined in Western countries. So any ban on Russian oil by the Western European countries will lead to a sharp shortage in supply of refined petroleum products, which the world can't afford today. So as it stands today, as it relates to Nigeria, unfortunately, Nigeria is not gaining as much as we should with this spike in crude price. Brent, like I said earlier, is trading about $126 today. And we are unable to increase our crude oil production. Our open quota for April this year is about 1,735 barrels a day. But we barely achieved 1.4 million barrels last month. So it's going to be a tough call for us to increase our crude production by as much as 300 or close to 350,000 barrels a day. So we're not taking full advantage of this. But on the converse, we're also carrying the entire burden of the increase in crude price. If you look at the price of AGO, for instance, AGO is trading in Lagos at the depot between 550 Naira and 620 Naira as of yesterday. That's a sharp increase from what it was before the war started. Fuel, which is our PMS, has also increased in price, although we are dealing with other endogenous or local issues, supply chain disruption. But part of the problem we're having with supply of fuel is also associated with the fact there's bottleneck in delivery of this fuel from where they are refined in Western countries to the country, beyond the issues that had to do with off-spec fuel that was imported. So, and with that increase in price, simply means there are several figures being bandied around. But certainly, the subsidy the federal government has to absorb will certainly be above the 3 trillion naira it had budgeted, because that budget was based on when crude price was about $70, $75 per barrel. But now we're talking of about $120, $126 per barrel, which means crude the subsidy we have to bear will be in the region of 4 to 5 trillion naira, which will have a direct impact on the government ability to invest in social infrastructure, as well as possibly lead to a major uptick in the government borrowing, federal government borrowing in this fiscal year.
Okay, Mr. Chukwu, you've raised a lot of points there, and let me see if I can chop them a bit. Let's talk about the oil price. It hit about $140 For countries, of course, even in a wartime, a lot of people would suffer, people would be killed, some others would also be smiling to the bank. And what's happening right now is Nigeria, as an oil producer, should be smiling to the bank. If we take a look at where oil price is, I think as of 2018 or so, it was actually said that we'll need oil to trade around $116 120 to have balance our budget, for us not to have a deficit. Do you see that happening at all, or has the higher subsidy levels will be paying as a result of higher oil price wipe that off? The second part, which I would also like to you to explain, is what you talked about earlier about AGO. I've been seeing the prices, and I'm wondering, is it a carryover of the fuel petrol shortage that is impacting diesel, or what exactly is it? We can't say it's this war for now, because it's been there before this war came up. A liter of diesel goes for, I think, 600 naira. Why?
Okay, let's start from the first part of your question. The fact that it was projected that we balance our books as a country at a year price of 120, 115, 116 was based on an assumption that we're going to be able to produce at least 1.7, 1.8 million barrels a day. If you look at our 2022 budget, it's based on 1.88 million barrels a day. We're currently producing just about 1.4 million barrels a day, barely 1.4 million barrels a day. And if we are unable to produce, you have what we call volume variance. So despite the fact that you're enjoying what we call positive price variance, in the sense that you are selling at the price beyond what you are projecting, you project about $62 per barrel, but we are selling about $120 per barrel. If you have that significant volume variance, then it offsets whatever gain you would have made from the increase in price. So ideally, if we were to produce remember this country used to produce about 2 million barrels a day, 2.1 million barrels a day. If we were to produce at that level, today we will not be smiling to the bank. Today we'll be talking of Naira exchanging for maybe $200 Naira to $1, because Naira would have strengthened. We would have today be talking of building back our foreign reserve. We would have been talking of excess crude account increasing, but unfortunately that's not happening. We are still seeing a depreciation in or a reduction in our foreign currency balance, foreign reserve balance. We are still seeing Naira under pressure, despite the fact that we are seeing crude price at about $126 per barrel, because we are not able to produce as much as we should. And the unfortunate thing is, when you are not able to produce as much as you should, and because we are 100% dependent on refined petroleum products, we are buying refined petroleum products and paying dollar for it at prices that are now elevated at high prices, because the price of refined petroleum products, it has a direct relationship with the price of crude. Once price of crude moves up, the price of refined petroleum product will move up. So we are not taking advantage of the increase in crude price, but we are absorbing the entire cost of increase in refined petroleum product, and that could actually be eroding completely whatever gain we're making from the increase in crude price. And that's why, like I said, we would have manifested, if it's not eroding the entire benefit we're getting from increase in crude price, we would have manifested an increase in our foreign exchange reserve, which would have helped strengthen our currency, which would have helped reduce the pressure on the local currency. And as long as you're not seeing this, then it simply means that the net effect of the increase in crude price and the increase in the price of refining petroleum products is negative for the country.
Okay, Mr.
A
Chukwu, let me jump in.
benefit would have manifested in reserve, a creation of reserve, but we're seeing a decline in reserve. So back to the second aspect of your question. The challenge we have, we should recognize the fact that AGO or diesel is deregulated, just like aviation fuel is deregulated. DPK, which is kerosene, is also deregulated. The only product regulated is PMS, which is fuel. So that means the price of AGO reflects the international market price of importing into the country. And that international market price will include what is Plat. Plat, like I said, and when I checked the Plat this morning, it was in the region of $1,500 per metric ton. And if you convert that to using the current exchange rate, you are going to have an FOB, free on board, which is just saying that you are paying for only the products of in the region of 550 naira per liter. And we're even dealing with, so you realize that anybody who is importing AGO to sell in today's market will sell at above 550 naira per liter. So it's all reflective of international market price of AGO. It's not just in Nigeria that this is happening. It's happening globally. The price of AGO has gone up universally because of the war and the increase in crude price. So because it has nothing to do with the bad fuel or off-spec fuel that was imported in the country, it has to do with the fact that this product is fully deregulated. The same thing is applicable to ATK, which is aviation fuel. You also observe that the ATK price has also increased astronomically. And like I said, these things are not unique to Nigeria. Anywhere in the world where these products are deregulated, the price have all gone up. Okay. And that's the reality. So we're dealing with a market reflective price of AGO in the local market based on what's happening in the global market.
Okay, Mr. Chukwu, let's take a step further. Let's take a step away from oil. Though I'm tempted to ask you more questions on it, but because of time, I want to move over to other things. I know we could have another conversation another time, because what I would have really loved to know is if what Putin of Russia has said, that oil price may get to $300 a barrel, what you think about it. But we can talk about that off air, or we can talk about that sometime later. Let's continue to watch the situation. Now, let's talk about the corporate exposure to what's happening in Ukraine right now, the war in Ukraine. The corporate exposure, we have companies in Nigeria, even the banks, for example. Let's start with the banks. Then I also want you to speak about the capital market exposure to Russia. We have a lot of high net worth individuals in Nigeria. You're someone right there in the market. How exposed are we to Russian assets? Though we've seen sanctions coming left, right, and center all over the world for Russia. Russia is the most sanctioned, the world's most sanctioned country now. Not even Iran, not Venezuela, not Cuba. It's the world's most sanctioned country. So how exposed are we? Our corporates too.
Okay, as a country, if you look at our capital market, it used to be significantly exposed to the Russian investors, but now it's not the case. But in spite of that, we have Nigerian corporate entities, we have Nigerian HNIs who are directly and indirectly exposed to the Russian financial system. And I will tell you how this is working. We have a few Russian financial institutions that have been operating in this country. I don't want to mention specific names. And those Russian financial institutions have leveraged from the Western financial systems, have borrowed from the Western financial system and lent to Nigerian corporate entities and Nigerian individuals. As it stands today, virtually all financial institutions in the Western countries, US, West European countries, have called back and canceled all existing facilities that extended to Russian financial institutions. What the knock-on effect of that is that these Russian financial institutions have also called back loans that they extended to Nigerian borrowers, both institutional borrowers and HNIs. And they are now forcing those Nigerian entities to sell down or sell off their assets to pay down on the loans that they own these Russian institutions so that they can pay back to their foreign or Western countries that have lent to them. What is happening today is that those assets are being sold at fire sale, so being sold on a fire sale. They are sold at current depressed market prices at best. And these Nigerian institutional investors and HNIs are locking in huge losses. What that means is that their economic resources are going to be severely affected. And with these operators, capital market operators, or have other investment in the country, they may also need to sell down those other assets to pay back these loans. Or some of these assets are invested in Nigerian Naira-denominated instruments, which also means that you're going to have some fire sale, which may be the reason why we've seen the equities market decline consecutively for the last couple of days, because I know that there are ongoing fire sales by Nigerian investors who are indebted or exposed to Russian financial institutions so as to make up for whatever liability that they owe these financial institutions, Russian financial institutions, who Western lenders have cut off their credits. So that is going to manifest in the market. But like I said earlier, in terms of direct investment by Russian institutions or institutional portfolio investors, foreign portfolio investors from Russia, it had diminished over time as a result of bottlenecks we've had. Nigerian economy has experienced in assessing effects. So what happened to other FPIs, like foreign portfolio investors, also happened to Russian investors. So they are stayed back on the sideline, but they're exposed to us through this channel which I've explained earlier.
Okay.
Then for Nigerians who are invested in Russia, I don't think we have so much of that. Nigerian resident or business operators who are very active in Russian capital market, but they may still be one or two of those such investors. They are also going to go through some hard time because the Russian government has said, look, any foreign investor who sold their assets cannot have access to foreign currency to convert and take their money out. In fact, the first instruction was actually to stop Russian institutions from allowing foreign investors to exit the Russian market. So even if you say you're going to sell at a depressed market price and you are not able to convert to dollar to exit that Russian market. So these are ways in this it would have affected the Nigerian financial system.
Okay, Mr. Chukwu, are you authoritatively telling me that we don't have portfolio managers that are Russia-originated portfolio managers or Russian-based portfolio managers in Nigeria? Should I take that authoritatively from you with what you've just said?
No, we do. We even have Russian financial institutions who have been licensed to trade on Nigerian stock, Nigerian NGX, Nigerian exchange.
Okay.
But what I said is that just like what has happened to other foreign portfolio investors, many of them have actually underweighted their portfolios on Nigerian Naira local currency instruments because of difficulties they've had in the past couple of months assessing FX. So they are not as strong or heavily invested as they used to be.
So what you're saying is that their impact will not be as high as we expect. What you're saying right now, because they've whittled down over a period of time because of our FX issues. Okay.
Absolutely.
Okay.
So the impact is not going to be as severe as it used to be. As it would have been if it was a time when we were heavily invested in the Nigerian market.
Okay. The other part of the question is the banks, really, because many of our Nigerian banks, or the big tier, the first tier, or the big banks in Nigeria do have exposure internationally. A lot of them have other African countries penetration. First Bank, GTCO, Access Bank, which other banks? There are so many, UBA and all of that. How do you think that this Russian invasion on Ukraine would likely affect those banks?
I think it won't be far from what I have explained earlier. There are other areas that the banks will be exposed to the Russian market. For instance, Russia is our 6th largest import market as a country. That is, in terms of ranking where Nigerians import goods from, Russia is the 6th largest market where we import goods from. So there must be existing letters of credit that need to be negotiated. Some of them may have gotten what we call unconfirmed letters of credit, which they, some form of credit that either the financial institutions in Russia would have guaranteed, or exporters in Russia would have granted Nigerian importers some level of credit. Those credits are likely going to be called, and Nigerian financial institutions where these letters of credit were established or these instruments of trade were passed through will be compelled or will be required to meet the obligations due to the Russian exporter. So that will certainly be going on now. But I also mentioned to you that in terms of the volume, Russia accounts for only 60 is the 6th largest import market for Nigeria. And some Nigerian banks at some point, I know we are enjoying some form of unlending credit facilities from including some of these Russian financial institutions. But I do not think the impact is going to be such as to materially affect the financial health of these big five or big six, if they're not six, tier one banks in the country. When you have a global issue of this nature, certainly anybody who has global operation will be affected in one way or the other, including us in Cowry. We also exposed to some Russian entities.
Yes,
and
in fact,
we have also had to navigate through that. But once you're operating at that level, you will be exposed to Russian entities and Russian financial institutions.
In fact, that was my next question, because it's as if you took it out of me, that as a fund manager, how are you delicately right now balancing assets? How are you managing funds at this time? That was my next question before you just said it. Are funds with you protected right now? How, you know where I'm going to, Mr. Chukwu. So answer me. And also the lessons, what lessons are we deriving, or fund managers such as you should derive from this global fallout?
Okay, a couple of things beyond exposing our trade secrets. One of the things we do is that we make sure that we do not negatively gap our balance sheet in terms of currency exposures. So we match our exposures to assets when it comes to currencies, because we all understand the Nigerian economy. We understand we have a very volatile foreign exchange environment. We're playing a very volatile foreign exchange market environment. So we make sure that whatever exposure we have in terms of foreign currency liabilities are also matched by foreign currency assets, and possibly actually make sure that we positively gap our balance sheet, which means we actually have more assets to cover for any liability exposure in foreign currencies. But like I said, that will now be on at a higher level of discussing and sharing our trade secrets. But the other things I want to mention here is that in every economic turmoil, there's always also opportunities for discerning investors to take advantage of. For instance, if you look at the Eurobond market, we've seen yield of some sovereign Eurobonds trade as low as 18%. That's there is no brainer to take advantage of such opportunity, because the war does not mean that the countries are going to go belly up. I mean, I don't expect that because Russia and Ukraine are fighting, that every country will fail to honor their sovereign debt instruments or Eurobond instruments. So the world, out of panic, has punished virtually all the countries in Africa in terms of the yield on their dollar-denominated liabilities. So it's an opportunity for us as descending investors to take advantage of that. But that's anybody who wants further on that should actually have an account with us, and that's we can take it off the screen.
Okay, let me allow it slide. I will take that off the screen. Just in like 2 minutes, just before we close the segment, you've also brought out the next question I wanted to ask. I don't know, are you in my head this morning? What exactly is happening? Because it seems you're in my head. I'm in
the spirit.
but you glossed over it a bit in terms of, the next question I wanted to ask you is, what should investors be buying right now? You've said one of it, which is Eurobond. So as an investor, what should I be selling right now because of this fallout? And what should I hold? What assets should one be buying, and what should you hold? Then the other part of the question is, as we round up, MPC March meeting we hold in a few weeks' time, whether 2-3 weeks' time. How delicate do you think that meeting will be? Because at every MPC meeting, geopolitical issues are also being discussed. In January, Russia was not an issue. This March, Russia is an issue, and we don't know when it would stop. Then also, as a consumer, how should I inflation protect myself? So 3 questions. How do I do inflation protection because of global inflation? Number 2, MPC meeting, March, Russia, Ukraine is on the table. How will Emefiele and his team navigate that? Number 3, what should I be buying? What should I hold? If you have more things to sell, you can also tell those that are with us right now. Okay. Fast, the stopwatch starts now.
Let's start from what you should be buying and what you should be selling.
Yes.
Because virtually all the assets are now depressed, is the time when you say hold and accumulate. If you have the economic resources, you can actually do margins to increase your portfolio size, because prices are already depressed beyond their intrinsic worth. And this applies to both equity instruments and fixed income instruments. If you look at the equity market, equity instrument space, you realize that there are some financial institutions that have declared dividends, which gives a dividend yield of more than 10%. And market is not responding positively to that. I mean, it's no brainer if you take a position on an instrument that will pay you dividend in March or April, and you buy an instrument that gives you a dividend yield of 10, 12%, the effective yield, if you even exit that instrument in June or thereabout, it's more than 40% per annum. So it's time to accumulate. But the only ones you run away from are those institutions whose underlying business have been negatively affected by the ongoing crisis, war. So in there, their object clause had been affected. So you are saying, look, this business may not continue to operate. This company may not continue to operate, and that's the way you should exit. Even if you're making losses, you cut your loss or minimize your loss and sell down. Then on the second aspect of your question, which is the MPC, I think it's going to be a very difficult meeting for them. A couple of other variables you mentioned have come into play. We were dealing with last one, we saw an improvement in inflation rate. Inflation dropped by about 3 basis points. And they were hoping that would continue, but we are seeing pressures are coming from the war, supply chain bottlenecks created by the war, increase in energy costs due to the war, and sanctions imposed on financial institutions on the Russian market have all led to pressures, inflationary pressure that are going to manifest in the month of March by the time the March inflation is announced. So the CBN will now be dealing with an elevated inflation rate. And beyond that, the CBN will also have to deal with unexpected additional pressures on our foreign exchange, which ordinarily should have been the opposite. Because like I said earlier, we see the decrease in our reserve as a result of obviously that we're spending more to import refined petroleum product than we are currently earning from increase in crude oil price, because we're not able to increase our crude production. So central bank has to deal with that. And the sanction, they also threats for additional sanctions by the Western countries. So Russia has threatened that if they sanction them, if they start importing their crude, they will cut off the Western countries from gas supply, which will lead to a major increase in inflation globally. Again, Nigeria, for instance, imports most of its wheat from Russia and Ukraine. Russia and Ukraine account more than 25% of global wheat production. We're already seeing that manifest in the price of bread, in the price of other confectionaries, and that would mean that central bank will be dealing with increase in inflationary pressure. Yeah. So I think the decision they will end up taking is to watch, because either way they can't afford to tighten, and at the same time they can't afford to loosen. So we're likely going to have them maintain rates at current level. Okay. The final part of the question is that how would households insulate themselves or protect themselves against the inflationary pressures that are currently evolving? One of the ways to protect yourself from inflationary pressure is to front load your purchases.
That is if you have money now.
I didn't get that, man.
That is if you have money.
Yeah, if you have money, but also if you have the capacity to leverage. If you have the capacity to leverage and you have strong cash flow that will come in subsequent months, it makes sense to leverage because the value of your subsequent cash flow will be diminished if you wait to consume at that point. So if you have anything to buy, it's time to buy those things now if you have money. If you have access to if you have access, you can use access to borrow. It makes sense to borrow because in periods when you have increase in inflation, borrowers gain while lenders lose because the value of money diminishes. So the naira you'll be paying subsequently has a lower value because you have consumed something that has a stronger value. So it's time for households who have assets that can borrow with those assets to front load their consumption or purchases ahead of the further depreciation in currency and further increase in inflation rates.
Okay, Mr. Chukwu, I think we'll leave it at that. So many things to talk about. Whenever we speak, anytime we speak, you know, it's as if we shouldn't end the conversation, but we've got to end it because we have another segment that is to come. Thank you very much for your perspectives today, and I hope that Nigerians have taken it. I'm not going to say it's still going to be tough, but like we always say, let God help us. So thank you, Mr. Chukwu, for joining us. All right, Johnson.
My pleasure.
Johnson Chukwu is the Group Managing Director at Cowry Asset Management. As we move along, Nigerian Governors Forum have described the central bank